Alright, this is Chapter 10, Property, Plant, and Equipment, and we're working through Wiley's Kieso text here, and this is Business 353. So we're talking about property, plant, and equipment, and talking about the accounting model basics, which it says right there. So the learning objectives are listed here. We'll talk about the role of property, plant, and equipment in business, and talk about how we recognize the property, plant, and equipment in our accounting records. We'll talk about costs and measurement, and we'll talk about different kinds of wrinkles in the recording of cost. So we'll talk about those as they go along. We'll talk about different kinds of property, plant, and equipment, and how costs may be different, and how they may be recognized differently in different kinds of property, plant, and equipment. We'll talk about the cost model, the revaluation model, and the fair value model for adjusting the cost of the asset over time. And we'll talk about the accounting treatment for costs after acquisition, sort of the repair versus extension, or capitalization versus expense treatment. And then we'll talk a little bit about the differences between ASPE and IFRS along the way, and I'll give you a reference at the end to tell you where you can see it's essentially illustration 10-15 in the text. It gives you a comparison of the differences between IFRS standards and the ASPE standards. And we'll talk a little bit about what changes are planned in the future for future accounting standards. There are two appendices to this chapter, so if you're interested in the borrowing cost to capitalize qualifying assets, that's in Appendix 10A, and the revaluation model using the proportionate method is discussed in Appendix 10B. I'll leave those for you. Some relevant references in the handbook are listed here. So there are a few different sections in the ASPE standards and a few different standards in the IFRS standards as well. The outline of where we're headed, with the exception of 10A and 10B, which we won't be covering in this presentation. But we're going to talk about property, plant, and equipment, and we'll talk about the definition, recognition, cost elements, measurement of cost at acquisition, after acquisition, and that's about it. So Chapter 10 presents a discussion of the basic accounting problems associated with the occurrence of costs related to property, plant, and equipment, and the accounting methods used to retire or dispose of these costs. So these assets, also referred to as plant assets, or tangible fixed assets, or tangible long-lived assets, long-term assets, are of a durable nature and include land, building structures, and equipment and natural resources. Property, plant, and equipment assets are an important part of the operations of most business organizations. They provide the major means of support for the production and or distribution of a company's product or service. Too little investment in these assets results in lost opportunities, whereas too much investment results in overcapacity and wasted resources. Therefore, to assess the company's use of investments and the potential future cash flows, users must be given sufficient information about these assets. So this chapter will introduce investments in property, plant, and equipment assets and how they're accounted for at acquisition. It then sets out and explains three different accounting models that are used to measure such assets, and the accounting treatment for costs incurred after acquisition. So we'll deal with those things as we go along. Property, plant, and equipment possess certain characteristics that distinguish them from other assets owned by the business. These characteristics are, well, essentially as follows. They're required for use in the operations and not for resale. So a tractor for a farmer as opposed to a tractor for a tractor sales firm. They're long-term in nature and usually depreciated over time. And they possess some sort of physical substance, so they're tangible assets as opposed to intangible assets. These assets usually last for a number of years, and their cost must be allocated to the periods that benefit from their use. Now, the recognition principle. Property, plant, and equipment accounts are valued at historical cost, just like other assets. Now remember, the assets have the definition as shown in the slide here, that it's probable that the item's future economic benefits will flow to the entity, and the costs of those future benefits can be reasonably measured. So, which ones do we capitalize as property, plant, equipment, and which ones don't? If they meet both of these conditions, the item is capitalized and recognized as a property, plant, and equipment asset. So, that's the definition we need to apply. So, property, plant, and equipment accounts are valued at historical cost at acquisition. It's the cash or cash equivalent price of obtaining the asset, bringing it to the location and getting it ready for its intended use. The sort of in situ cost we've talked about in 253. Property, plant, and equipment is recognized when the cost of the asset can be measured reliably, and it is probable that it generates future economic benefits. So typically costs include purchase price, import duties, non-refundable purchase taxes, delivery costs, less discounts and rebates. Lots of components to the costs can be considered. Now in subsequent periods, property, plant, and equipment is valued at either cost or fair value, and companies can apply either method, at either cost or fair value, to all the items of property, plant, and equipment, or to a single class of property, plant, and equipment. Most companies use the cost method because it's less expensive. In addition, the fair value method generally leads to higher asset values and higher depreciation amounts and lower net income. So obviously there are some reasons not to do that. The degree to which asset components are combined and recognized separately requires professional judgment. Factors to consider, though, include the cost or benefit of separate recognition with reference to the significance of the component to related components, if they have different useful lives, or if they have different patterns of delivering benefits. So if an item of property, plant, and equipment meets the definition and recognition criteria, two issues need to be addressed, which we'll talk about in our further discussion along the way. One of them is the elements of cost to be capitalized, and secondly, how cost is actually measured. Now, cost elements. The cost of an item of property, plant, and equipment includes all the expenditures needed to acquire the asset and bring it to its location and ready it for use. So these would include purchase price, net of discounts and rebates, trade discounts and rebates, plus any non-refundable purchase taxes and duties. So if you're buying it from a foreign country and you have to pay duties across the border, that would be part of the cost. Expenditures necessary to bring the asset to its required location, so shipping costs and condition, and to its required condition to operate as management's intending, including any employee costs needed to acquire or construct the asset. Delivery and handling costs, site preparation, installation, assembly costs, net material and labor costs incurred to ensure it's working properly, and any professional fees that are required. The estimate of the cost of obligations associated with the asset's eventual disposal should also be included in the cost, and this includes some or all of the costs of the asset's decommissioning and site restorations at the end. Excluded costs, costs that should not be included in the cost of property, plant, and equipment, would include initial operating losses, so learning how to run the machine, the cost of training employees to use the asset, learning to run the machine, costs associated with the reorganization of operations, so if you have to reorganize operations to consider the new technology or to use the new technology, that reorganization is not part of the cost of the asset. Any administration and general overhead costs that are allocated to this department should not be included in the cost of the asset. Any of the costs of opening a new facility, introducing a new product or service, and operating in a new location, all of those costs should be properly allocated to the appropriate place, and wouldn't be a cost of the property, plant, and equipment that's used in the new facility, or to produce the new product, or to operate in the new location. That general principle applies to both IFRS and ASPE. However, there are some differences in application, specifically as it relates to costs incurred when assets are constructed internally rather than purchased outright, and associated borrowing costs, and site restoration or asset retirement costs. So those are the three sort of major areas of difference between IFRS and ASPE, and once again you can see that discussed in your textbook in illustration number 10-15. So let's talk about self-constructed assets. This is one of the differences between IFRS and ASPE. When plant and equipment to be used by an entity are constructed rather than purchased, the cost of materials and direct labor are easy to identify. They're traceable, as we discussed in management accounting, and allocated to the constructed assets. However, a problem may exist concerning the allocation of overhead costs. These costs may be handled in one of two ways. Either they would assign a portion of all overhead to the constructed asset, or they would assign no fixed overhead to the cost of the constructed asset. So variable overhead relatively traceable, so variable overhead would be included, but fixed overhead, you would have the choice of either including the fixed overhead allocation or just the variable costing. So the inclusion of fixed overhead is often called full cost or a full cost approach. So for property, plant, and equipment, only directly attributable costs can be allocated to the asset cost. Therefore, none of the fixed overhead is usually charged unless the company is involved in significant self-construction activity, in which some of the fixed costs may be considered directly attributable. So, in general, property, plant, and equipment should not include fixed overhead costs unless it's the normal practice for the building for the company to construct a lot of their property, plant, equipment. A lot of their property, plant, and equipment in-house. Borrowing costs during construction. Interest costs incurred in connection with financing the construction or acquisition of property, plant, and equipment may be capitalized if they're directly attributable to the asset. So you're getting financing for that asset in particular, as opposed to sort of a general financing obligation, which is used for different purposes as it becomes available. So if it's directly attributable to the asset, it would be capitalized to the extent that the costs are avoidable and incurred during the period that the asset is being brought to its required location and conditioned to operate as management intends. This is the method that's required under IFRS. Now, ASPE will permit the choice of capitalizing or expensing, but the policy chosen and the amount capitalized must be disclosed. This enables users of financial statements to determine the impact of capitalized interest on the financial statements, and so the appendix, as mentioned, looks into this issue in more detail in Appendix 10A. Dismantling and restoration costs. These are so-called AROs, or asset retirement obligations. And asset retirement obligations are those costs associated with the eventual retirement of long-lived assets. So under IFRS, the costs of both legal and constructive obligations, constructive not in terms of building something, but constructive in terms of construed obligations. So an obligation would be construed even if it's not statutorily required, if it's the normal practice, and you would probably get in trouble with your industry association, or for some other reason, it's sort of a more on the side of a moral obligation as opposed to a legal obligation, then it's construed to be your obligation, and those are called constructive obligations. So construed as opposed to constructed is the basis for that word. So costs of both legal and constructive obligations are recognized, whereas ASPE recognizes only costs associated with legal obligations. So under IFRS, you may recognize your moral obligation in addition to your legally required obligation. Under IFRS, costs would include those related to the acquisition of the asset, but not those related to the use of the asset in the production of goods and services, whereas under ASPE, costs are not distinguished in that way, so costs could include both. The measurement of cost involves a number of accounting problems. A number of accounting problems are involved in the acquisition and valuation of tangible capital assets. And in general, an asset should be recorded at the fair value of what is given up to acquire it, or its own fair value, whichever is more clearly evident, whichever is a more reliable measure, is another way of putting that. So this appears to be a rather straightforward approach that can be easily followed. However, determining the fair value is not always as easy as it might appear to be. So some of the problems one encounters in determining proper valuation are discussed in the next few slides. An example of one of those problems that we might have to deal with is a discount. The purchase of a planned asset is often accompanied by a cash discount for prompt payment. If the discount is taken, it results in a reduction in the purchase price of the asset. It is not recognized as a purchase discount because purchase discounts are related to inventory purchases, and so we've dealt with those separately in other areas. And inventory purchases form a part of the cost of goods sold. However, when the discount is allowed to lapse, should a loss be recorded? So the question arises, if you actually don't take the discount, should you record a loss, or should the asset be required at a higher purchase price? So currently, while recognizing the asset at its lower cash cost is preferred, both methods are actually employed in practice. Essentially, the cash discount isn't necessarily recorded as a reduction in the cost of the asset. What they're saying is that if there's a cash discount for early payment, If you make that early payment, you're basically saving interest cost in that situation. So if you make the payment early, you get a cash discount. If you make it late, you have to pay more. That difference in cost would be in the nature of an interest expense as opposed to the cost of the asset. So the interest expense should be attributed to the period as opposed to the purchase of the asset. In practice, though, it's really hard to show or prove that you didn't take the cash discount that was available to you, because you have to go back in time and determine the cash discount that was available at the time, and that's kind of difficult to do. All right, deferred payment contracts. Sometimes planned assets are purchased on deferred payment contracts, and they should be accounted for at the present value of the consideration exchanged on the date of purchase. And that measure is consistent with the IAS 16 definition of cost, which includes the fair value of other consideration given to acquire an asset at the time of its acquisition or construction. So when the obligation doesn't stipulate an interest rate, you would have to determine an imputed rate of interest, and so you would have to determine that for use in calculating the present value, of course. So factors to be considered in imputing an interest rate would be the borrower's credit rating, the amount and maturity date of the note, and prevailing interest rates in the market. If you could actually determine that, the cash exchange price of the asset acquired should be used as the basis for recording the asset and measuring the interest element. So you're paying essentially the current price and attributing the interest from paying over a deferred payment arrangement. You're essentially paying interest on the purchase of the asset. So if you can determine the fair price or the cash exchange price of the asset, that should be the basis for the price of the asset, and the additional cost for paying on a deferred payment plan would be recorded as interest expense using something similar to the effective interest method that we talked about. We've talked about in several contexts so far in the class. So here's an example. We have Sutter Corporation, and they have a 5-year $100,000 non-interest bearing note, which is issued in exchange for new equipment. So they're going to pay in 5 years, and it's $20,000 per year that they're going to pay. The relevant market interest rate is 10%, and so we would have to record the acquisition of the equipment given that information. Well, first of all, we need to calculate the present value of the note, and it's a simple annuity. So in your financial calculator, the payment, PMT, would be $20,000, N would be 5, and I per Y would be 10%. And there would be no future value, because when you're done paying it, you don't owe them any money. So you would calculate the present value of that annuity. It would be $75,816, and that's how much the asset value should be recorded for. So we debit equipment, credit notes payable for $75,816, and then we would record interest expense as we amortize the notes payable into income over its life. So in the first year, we would have $75,816 times 10%, assuming, of course, that we bought it on the first day of the year. So $7,582, or $75,8160 if you're being picky, would be the interest expense, and the notes payable would go up by that amount. And then when you made the payment, of course, the notes payable would go down. Rather than setting it up as notes payable, you could set it up as interest payable, I suppose, and then pay that as well. Either way, it would be recorded as, I guess the notes payable would be partially long-term debt and partially current assets, or current liabilities. Anyway, so it doesn't really matter whether you call it notes payable or interest payable. And then, of course, you'd amortize as you made the payments. You would amortize it like paying off any other liability over time. All right, so what about a lump sum purchase where you buy a few assets? So if you purchase a group of assets at a single lump sum price, or a basket purchase, it's often referred to as a basket purchase. The best way to allocate the purchase price of the assets to the individual items is based on the relative fair values of the assets acquired. The assumption is that costs will vary in direct proportion to those values, and so to determine the fair value, an appraisal for insurance purposes, or the assessed valuation for property taxes, or simply an independent appraisal by a qualified appraiser might be used. If you have an in-house appraiser, if they can provide evidence to support their valuation, that might be possible. We had an appraiser of that sort when I worked for Coopers & Lybrand Limited in their bankruptcy and insolvency practice for about a year. at Coopers and Lybrand, we had an in-house appraiser, and so he was quite well aware of the different values of assets, and so one of the reasons we hired him is because of that expertise, and it's much cheaper to use that than to pay somebody else outside the organization. So here's an example. Let's say we bought some inventory, land, and a building, and the total price paid was $80,000. Oop, I missed a slide. I knew there must be some information there somewhere. So here's our lump sum purchase. The inventory, land, and building are purchased for a lump sum of $80,000. How do we allocate that on the fair value, the relative fair value basis? Well, inventory is worth 25, land is 25, and building is 50. So that's a total of $100,000. So just the proportional allocation means that of the 80,000, 1/4 of it, 25%, 25 out of 100, is $20,000, and so 20,000 gets allocated to inventory, 20 to land, and 40 to the building. Of course, that's rather important in terms of your future income, because the building is deductible over time. The inventory is expensed as soon as you sell it, so it's cost of goods sold, and the land would just sit on your balance sheet without changing because it's non-depreciable. So it makes a difference, and so the accuracy of this calculation is fairly important. What about if you pay shares for your property? So when assets are required or acquired for an entity's shares, the best measure of the cost is often the fair value of the shares issued. If they're publicly traded in an active market, then you have a very clear objective valuation, independent valuation of the value of the shares, and so you can use that to value the asset that you're giving up. So IFRS allows using the fair value of the shares only if the fair value of the shares cannot be, the fair value of the assets can't be determined, whereas ASPE allows whichever one is more reliably determinable. So IFRS says you need to determine the fair value of the asset itself. The fair value of the shares is somewhat dependent on the value you set for these for the property you're buying. So in that sense, the IFRS public company, the risk of having public company manipulation of values is significant for IFRS and less so for ASPE. So that might be one reason for the distinction between the two. Exchanges of assets. What if you're giving up another asset other than cash or some kind of financial instrument? What if you're exchanging one asset for another one? Well, there are a couple of different flavors. The monetary exchange of assets is when non-monetary assets are required for cash or other monetary assets, so that's kind of the normal situation, or non-monetary assets are disposed of in exchange for monetary assets. Those are generally quite easy to value, and so those have already been discussed to some degree. But the issue of non-monetary exchange of assets is a little bit more complex. Non-monetary exchanges of assets involving transactions where non-monetary assets are exchanged for other non-monetary assets, with little or no cash or other monetary assets changing hands, requires that you assess the economic substance of the transaction. So you need to determine what's actually going on. As stated previously, ordinarily companies account for the exchange of non-monetary assets on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. Thus, companies should recognize immediately any gains or losses on the exchange. The rationale for immediate recognition is that most transactions have commercial substance, which is, sort of code for saying that that we're actually making a sale transaction, or one of us is making a sale transaction. So the rationale for immediate recognition is that most transactions have commercial substance and therefore should be recognized. An exchange has commercial substance if the future cash flows change as a result of the transaction. So, for example, an exchange of trucks with different useful lives might have commercial substance, while an exchange of trucks with no significant difference in useful lives would probably not. So you're just exchanging trucks that you're going to use for the same life and the same purpose and the same action. There's really no change. You would just exchange book values in that case. And if there is commercial substance, as indicated by a change in cash flows as a result, you would record the fair values in the way we're going to describe. The requirement to use fair value will not apply if fair values are not reliably measurable, or if the transaction lacks commercial substance. So commercial substance being a significant change in the company's expected future cash flow. In an exchange that lacks commercial substance, the book or carrying value of the assets given up, including or subtracting any monetary consideration given or received, would be used as the basis for the asset value for the new assets. In no circumstances can an asset be recognized as more than its fair value. So if the book value of assets given up exceeds the fair value of the assets received, the new asset would be recorded at the lower fair value amount, and so you would recognize a loss in that situation. Now, companies immediately recognize losses they incur on all exchanges, and the accounting for gains, that's kind of the prudence concept, right? Or conservatism as we used to refer to it. The accounting for gains depends on whether the exchange has commercial substance. If the exchange has commercial substance, the company recognizes the gain immediately because they've actually exchanged it with real change in future cash flows, so they can demonstrate that, and they would be able to recognize the gain immediately in that case. If an exchange lacks commercial substance, the gain would be deferred, presumably until the time that the asset was disposed. A gain or loss on the exchange on monetary assets is computed by comparing the book value of the asset given up with the fair value of that same asset, and the examples that we're going to talk about below are designed to demonstrate various situations where exchanges of non-monetary assets are included. So, let's look at those examples. Here we have one for a company IPI, which exchanged a used machine for a new model. Used versus new probably indicates commercial substance because it's a different life expectation, and so you'd be expecting at least more years of cash flows, if nothing else. The fair value of the used machine is $6,000. The book value of the used machine is $8,000. Original cost of $12,000 minus accumulated depreciation so far of $4,000. So they paid the cash. They paid cash of $7,000 to the seller, to the vendor, the seller. It says right there, seller. So how would you record the purchase in their books? Well, you would record the new equipment at the cost of $13,000, and that would be the fair value of the used machine you gave up, and the cash paid to the seller of $7,000. And you'd have to get rid of the old machine. So the old machine's got to go away. The accumulated depreciation on the old machine goes away, $4,000 debit. The equipment, the old machine original cost, goes away for $12,000. Cash goes away because we don't have it anymore, $7,000. And there we have our loss on disposal, which should be in the debit column because it's a loss. And so I'm not quite sure why it's straying to the right side of the page there, but you should put that over in the debit column. So the debit column, 13 plus 4 plus 2 is 19. The credits column, 12,000 and 7,000 also adds up to 19. So we're happy accountants because our journal entry balanced, which is a good thing. What if we exchange some trucks for land? Well, there clearly we have commercial substance because trucks and land do have quite different cash flows. Fair value of the trucks is $49,000. The book value of the trucks. So clearly, if we know this information, we're giving up the trucks and getting the land. So the book value of the trucks is $42,000. Original cost was $64 minus the accumulated depreciation of $22 leaves us with $42. And we're going to pay cash in addition to the trucks of $4,000. So what is the land value? Well, it's the $49,000 fair value of the trucks given up plus the $4,000 in cash. That's $53,000. So debit land, $53,000. The truck all the trucks have to go away. So we get rid of their accumulated depreciation of $22 and their original cost of $64. We paid cash of $4,000. So this all nets out to a gain on the disposal of these trucks, and we made $7,000 on the exchange. So once again, we check the debits and the credits, and they add up, and that's good. So 75 and 68, 75 on the right-hand side. That's good. It balances. What about Westco Limited exchanging a commercial property in Ontario for an almost identical one in Alberta? And the other company was Eastco. So Westco gets the Ontario property, and the Alberta gets the Alberta property. Westco probably being Alberta and Eastco probably being Ontario, I suspect. So let's take a look at the terms. The Eastco property, we know the book value of the Eastco property, we know the book value of the Westco property, we know the fair value of the Westco property. So the Westco property is presumably the one we're giving up. Yes, so the West Coast property is presumably what we're giving up, and the East Coast property is the one we're getting. So I think what that's saying is that West Coast is giving up the Ontario property, and Ontario is giving up the Alberta property, which makes sense. It's close to home and all that, right? Anyway, the fair value of West Coast property was $615,000. The book value is $420. Original cost $520. Accumulated depreciation of $100,000. That's the one that has to go away, as we see below. The accumulated depreciation goes away. Debit of $100,000, and the building original cost goes away, $520,000 credit. We also paid $30,000 of cash, so that's got to be in the deal. And so the new building is recorded with no gain or loss. So the new building has the same net characteristics as the old one. We don't use the fair value of the West Coast property to determine this because of the lack of commercial substance. So we're just exchanging one for another one. There, you could probably make an argument for cash flows being better, because you wouldn't have to fly to Ontario to take a look at your property. But anyway, I'm not going to dispute the fact that the slide says right there in front of us, assume no commercial substance. So if there's no commercial substance, there's no gain or loss. What about contributed assets and government grants? I suppose we could actually change the slide to say that if we want. So this is contributed. Oh, we don't have room. Let's take it right out. So contributed assets and government grants. These are referred to as non-reciprocal transfers. So transfers of assets where nothing is given up. So for example, donations, gifts, or government grants. Many companies receive assets through donations from other organizations, individuals, or the federal government. And these transactions, as I've said, are known as non-reciprocal transfers because nothing is given in exchange. So when an asset is received through this method, through the donation, through a non-reciprocal transfer, the appraisal or fair value of the asset should be used to establish its value on the books. And there's two general possible approaches that we could use to record the credit for a non-reciprocal transfer transaction. We could use a contributed surplus account, such as donated capital that would appear in the shareholders' equity section, which is what we call a capital approach to the recording of this non-reciprocal transaction. So basically we're saying that they contributed something similar to being a shareholder. So a shareholder gives money to the company. There's no gain or loss on that exchange. It's just recorded as the value of their equity capital, contributed capital. Or we could actually treat it as an income approach, in which case we would record the income of that asset. So we're getting something for free. There's a benefit, there's a gain, because it doesn't cost us anything. And so within that income approach, we have a couple of different approaches that we could use for that. So the income approach, if the contribution was by a non-owner, such as the government, it's reflective of the income approach in that the contribution is a non-owner source of changes in net assets. So you don't actually have an ownership interest being demanded by the government contribution. So it's presumably trying to meet some kind of social objective that they have. And so they gave you the asset without any intention of taking an ownership interest in the company. So if it's a non-owner that's making the contribution, the contribution is a non-owner source of changes in net assets, then the issue under the income approach is whether the revenue should be reported immediately or over all the periods that benefit from the grant. And the amount received should be deferred and recognized over the period that the related assets are used. That's the conclusion that we've come to. So there are two approaches that could be used. We could reduce the cost of the asset, cost reduction approach. So we should have the effect of reducing the cost and therefore reducing depreciation in the future periods. And so the income, the change in the income would be the reduction in the depreciation expense. So the weakness with the cost reduction approach is that it reports assets at less than their fair value. We could defer the amount, so the deferral method, deferral of the amount of the grant in a separate account and amortize it into revenue over the life of the related asset. The weakness of this method is that the deferred revenue account doesn't really meet the definition of a liability because we don't have anything to pay back. So, a donation of land is even more problematic because it's not depreciated. So in this case, the donation may be deferred and taken into income over the future periods that will benefit. If there's no way to associate the grant with future periods, the full grant is recognized as revenue, and whichever method is used, the policy must be disclosed. So this is something that hasn't actually been determined. There's a number of different ways that it's actually been used. We used to use the capital approach back when I was in school. So whenever we got a government grant, sorry, I'm lying to you, we used the cost reduction method. So we actually would report the government grant. We used to have something called the ITC, investment tax credits, and those investment tax credits were given for investing in certain kinds of assets or in certain locations. And so if you bought one of those assets and put it in one of those locations, you got a grant, and that investment tax credit, basically it's a credit on your taxes, so you don't have to pay as much taxes. We used to just put it through the cost reduction method, but as it says, that means that the asset is recorded at less than its fair value, which in any of these methods you're telling a bit of a story. But it's a fairly unusual transaction, so it's not really a commercial transaction in the sense of accounting measurement. So it's a bit of a strange animal. All right, costs associated with other specific assets. So we've talked about contributed assets. Now there are a number of different assets that have different kinds of costs, and so here we're talking about land. A more general discussion of the idea of associating costs with specific assets. Assets normally classified on the balance sheet, the statement of financial position, as property, plant, and equipment could include land or buildings or various kinds of machinery and equipment. We could even have natural resources such as gas and oil. And so the cost of each item includes the acquisition price plus those expenditures incurred in getting the asset ready for its intended use. So in situ is kind of the term we use. Let's begin with land. Land acquired for operational use is classified as property, plant, and equipment. And so land costs would include the purchase price, any closing costs, so your lawyer costs, your paying fees to the municipality it's located in to approve all of the required permittable applications, all those sorts of things. There are a number of things that go into closing costs, title, legal, and recording fees. The cost of preparing the site, so grading, filling, draining, clearing, all that kind of stuff that you have to do to get it ready to use for your purposes, whatever it might be. If you have to assume any liens or mortgages or other encumbrances on the property, the cost of doing that, so a legal transfer of the contract, would be added to the cost. Any additional land improvements that have an indefinite life would be included as well. Improvements that have an indefinite or have a definite life would be treated as their own kind of asset because they don't actually fit the indefinite life of land. In addition, the cost of removing any existing structures, less any salvage value, is a land cost. So if you have to take stuff off of there in order to use the land, remove any existing buildings, that would be part of the cost of the land as well. If there are any special assessments for local improvements that are permanent in nature, they would be included as land costs. So if you have to do something to meet the city's requirements or wherever municipality you're working in, those would be included as land costs. If you made any improvements with limited lives, those would be classified as land improvements, or if they're in the character of some other asset, they would be recorded as that asset. But land improvements would be depreciable. Land would not be depreciable. Land purchased for a speculative purpose would be appropriately classified as an investment. So they're not part of the property, plant, and equipment. They'd be classified as an investment. If a real estate concern holds land for resale, it's classified as inventory. So again, the context makes a difference in terms of how we would treat the accounting. The cost of removing an old building, if I finish my discussion, the cost of removing an old building from land purchased for the purpose of constructing a new building is properly charged to the land account. Also, when improvements have a limited life, such as fences, driveways, and so on, are made to the land, they should be set up in a separate land improvements account and would be depreciated over their useful life. Building costs. Building costs would include materials, labor, overhead costs incurred during construction, if you're constructing the building. Also, any fees such as building permits, the services of attorneys and architects, all of those would be included in the acquisition cost. In general, all the costs incurred from excavation of the site to completion of the building are considered part of the building costs. If a company has a building that it owns and has been using, the cost of demolition, net of any cost recoveries, are expensed as disposal costs, which will increase any loss on disposal of the old asset. An exception is allowed under ASPE when a building is torn down to redevelop rental real estate, in which case the demolition costs, along with the remaining carrying amount of the building, would be capitalized as part of the redeveloped property, to the extent that the cost can be recovered from the project in the future. Leasehold improvements revert to the lessor at the end of the lease. And because the lessee has the right to use those assets over the life of the lease, the costs are capitalized as leasehold improvements and depreciated as an operating expense over the life of the lease, or the useful life of the improvements, whichever is shorter. So if your lease is 20 years and your leasehold improvements are going to last for 10, you would use the shorter of the two numbers. Of course, they're not your assets anymore after you leave the lease, so at the end of the lease, they become the assets of the lessor. So that would maximize. But that's why the other maximum, the life of the lease. The equipment cost would include purchase price plus all expenditures related to the purchase that occur subsequent to acquisition, but prior to actual use. These related costs would include all of the items listed here: freight charges, insurance charges on the asset while it's in transit, assembly installation costs, special preparation of facilities to receive the asset, any asset testing costs, those sorts of things would be added to the cost of the equipment. Investment property, property that's held to generate rental revenue, for example. Rental real estate is a separate category of property, plant, and equipment that's defined as property held to generate rentals and or appreciate in value rather than sell in the ordinary course of business or to use in production, administration, or supplying goods and services. So the cost of the property under IFRS and ASPE is determined following the same rules used for property, plant, and equipment. If the property continues to be accounted for at cost, then the components of the property, for example apartment buildings on the investment property, are accounted for separately for purposes of depreciation. Costs of natural resource properties. Natural resources, also known as wasting assets, are characterized by two main features. You're removing the asset or consuming the asset. That's one feature. And second, replacement of the asset is only by an act of nature. So you don't actually build the replacement asset yourself. So natural resources, complete removal or consumption of the asset in its use for the business, and the replacement of the asset isn't by you but by an act of nature. So such resources would include things like oil and gas, in our Alberta example, mining properties, for example. Significant expenditures are required to find natural resources, and so for every success there may be failed attempts where nothing is discovered. And costs that are capitalized would be related to acquisition costs, which is the price paid to the property, the price paid for the property rights to search and find an undiscovered natural resource. Royalty costs paid to the Alberta government would be included. The price paid for an already discovered resource from someone who already discovered it would also be part of the acquisition costs. Exploration costs, costs incurred to identify areas that have potential for the existence of natural resources, would be included as well. These would include depreciation and operating cost of special equipment dedicated to these activities. So exploration costs may be expensed in their entirety or capitalized to the extent that they relate to successful projects, which is the successful efforts approach, or they can be capitalized in their entirety to all projects whether or not they are successful. This is the full cost approach. And so there's quite a difference between the balance sheet and income statement effects of the successful efforts approach and the full cost approach. You need to actually be able to find exploitable property in order to have the successful efforts approach. For example, so development costs. Development costs would be a cost incurred to obtain access to the proven resources, or reserves, and to provide facilities for extracting, treating, and storing the resource. So such costs would include depreciation, operating costs of support equipment, drilling costs, tunnels, shafts, wells, anything that's required to actually develop the reserves for removal. And then, of course, decommissioning and site restoration costs would be costs associated with the retirement of the capital asset for which the entity is legally responsible, and they're estimated based on the present values of those costs are included in the asset cost and the depletion base. So all of those costs would be would comprise the depletion base of the natural resource, and through depletion, which is like depreciation but based on the units of production. So you estimate how much reserves you have, and as you take them out of the property, you would record the depletion of those resources. And through that process of depletion, these costs of the natural resource become part of the cost of inventory that is produced, similar to how the cost of direct materials used in production become part of the cost of a manufactured product. So how do you account for a mineral resource property? Well, the two main methods of accounting, as we noted, are the full cost method and the successful efforts method. IFRS 6 doesn't actually discuss these. The full cost method is covered by ASPE in Accounting Guideline 16. Under the full cost accounting method, companies capitalize all of their exploration costs, even those representing dry holes, so even if you don't find anything. So you capitalize them, which means you record an asset as exploration costs, and so you treat them as an asset as opposed to expensing them. And so even if you don't find any oil and gas reserves, you would capitalize all of those costs. The successful efforts approach, which is the main competitor, under that approach the companies would initially capitalize the exploration costs until the drilling activities are determined to be not successful, and if there's no proved reserves found, then the costs are written off to an expense as a dry hole. So a successful efforts approach only capitalizes the cost of demonstrably successful efforts for exploration, whereas full costs, you pay all those extra costs for the dry holes in order to find the good holes and the productive wells. Alternatively, for successful efforts exploration activities that are likely to be commercially developed, the cost would remain capitalized as an asset until production and related amortization would begin. So if you find good holes, and that's what I think maybe in my last point was a little unclear. Under successful efforts, if you actually do find wells that you can commercially develop, the cost would remain capitalized as an asset until you begin production, and then that amortization of those costs would be brought into income over the life of the well. Alright, biological assets. Examples of biological assets would include the ones listed here: fruit trees, grapevines, livestock. Under ASPE, the general principles applicable to PP&E, property, plant, and equipment, are also applicable to biological assets. However, under IFRS, these assets are measured both initially and at each statement of financial position date at fair value less the cost to sell, with changes in value recognized in the income statement similar to the fair value model. So essentially, these biological assets are recorded as they grow and produce fruit or beef or whatever it might be. The fair value less the cost to sell would be measured, and you could actually record the asset value at that value. If the fair value is not reliably available, then cost less accumulated depreciation and impairment losses would be used in that case. Measurement after acquisition. What if transactions happen after the acquisition transaction? Well, companies have a choice between three different models depending on the type of asset and whether international or private entity standards are being applied. So international or ASPE, IFRS or ASPE. The three models are a cost model, a revaluation model, and a fair value model. Now, the cost model is the most widely used and familiar. Property, plant, and equipment is measured at its cost to acquire, less accumulated depreciation, and any accumulated impairment losses. So depreciation and impairment losses would be covered in Chapter 11, the next chapter along the way. And the process of allocating the historical cost of property, plant, and equipment to the periods benefited by that asset is known as depreciation, and so depreciation is an application of the cost model in that case. So that's kind of the standard model. ASPE says that the cost model is the appropriate model. Under IFRS, we can use one of these other models in particular situations. For investment property assets, we can use the standard cost model, or we can use the fair value model. And for other kinds of property, plant, and equipment assets, either the cost model or a revaluation model, and we'll talk about those below. So here's the first one, revaluation model. Under the revaluation model, property, plant, and equipment assets that can be reliably measured at fair value are carried after acquisition at fair value, less any subsequent accumulated depreciation and subsequent impairment losses. While it's not required to be undertaken at each reporting date, the revaluation must be carried out often enough that the carrying amount reported is not materially different from the asset's fair value, and fair value would be the price agreed to in an arm's length transaction. Professional valuators will use active market or market-related evidence when possible, but if the asset is very specialized, alternative methods might be needed. So they might actually need to be able to calculate the present value of the future cash flows, for example. So if you're going to start revaluation, you're in it for the long haul. If the change results in an increase in the asset's value, the amount is recorded as a credit to revaluation surplus in the equity. That's an equity account, unless the increase reverses about revaluation decrease previously recognized in income. So if so, the increase is recognized in income to the extent of the prior decrease, and then if there's any additional change in value, it becomes part of the revaluation surplus. If the change results in a decrease in the asset's carrying amount, then the amount is recorded as a debit to the revaluation surplus, an equity account, to the extent of any credit balance associated with that asset. In other words, this account can't have a debit balance. So it has to be either an increase in value or nothing. Any remaining amount would be recognized in income, which means you would expense it or record it as a loss. Now, amounts debited or credited to the revaluation surplus account are reported in the statement of comprehensive income as other comprehensive income. So there's no net increase in net income from revaluing the asset. The balance in the revaluation surplus account can be transferred to retained earnings at the end of each period, or it can remain there until the asset is retired or disposed. The effect on the valuation of the associated asset can either be accomplished by adjusting the account proportionately between the carrying amount of the asset and the accumulated depreciation. So you basically adjust both the cost account and the accumulated depreciation up to the same proportionate, the percentage of the cost. That's the proportionate method. Or you can eliminate the accumulated depreciation account, which is the asset adjustment method. So basically you revalue the cost of the asset and then start recording depreciation again. So here's an example. Convo Corp purchased a $100,000 building on January the 13th, and their year-end date is the 31st, so we get a full year. Gets revalued every 3 years, depreciated on the straight line method. So the useful life is 25 years, and there's no residual value, so 100 divided by 25 is approximately $4,000 per year, the initial estimate of depreciation. The fair value at the end of the 2015 year is $90,000. So we bought it at the beginning of 2013, 2014, 2015. That's 3 years. We're doing a revaluation. And then we're going to do another revaluation 3 years later. The value has gone down to 75. So 100 down to 90, down to 75. So how would you record all of this in journal entries? Well, at December 31st, 2015, the value of the building has gone down to $90,000. And we've been depreciating it for 3 years. So $4,000 per year times 3 years, we've depreciated for $12,000. So before the revaluation, we've got a cost of $100,000. Accumulated depreciation is $12,000, so that gives us a carrying amount of $88,000. And then we make the revaluation. We do the fair value determination. It's worth $90,000. So how do we make the adjustment? Well, we restate. Well, first of all, we take the accumulated depreciation and offset it against the building. So we get rid of the accumulated depreciation so far. Hold it. I might lie to you. Back up here. Accumulated depreciation is debited, and usually it would be credit. So yes, we get rid of it, and we get rid of the $12,000 from the original cost. So we restate the asset to $88,000, and so we basically reestablishing the carrying value at the net amount, and then we revalue the building up to a value of $90,000. So we debit the building and credit the revaluation surplus in the other comprehensive income. So that's how we get rid of the accumulated depreciation. So that would be an example. We go back one slide here. Go back one more slide. The choice that we have to eliminate the accumulated depreciation account, the asset adjustment method. Okay, it's not actually on that slide anywhere. Oh, interesting. You can actually see that up here. Oh, okay. So I just read my notes about the asset adjustment method. Cool. So that's the asset adjustment method. We actually get rid of the accumulated depreciation and restate the building at a brand new cost. And then again on December 31st, 2018, now it's worth $75,000, and we have it revalued at $90,000. And then when we revalued it at $90,000, we got 22 years left, so that's $40.91 per year times 3 more years. $12,273 is the amount of depreciation for those 3 years. The $90,000 building minus the $12,000 gives us a carrying amount of $77,727, which is a difference of $12,273 from the revaluation balance of $75,000. So we first of all undo the depreciation and reduce the cost of the building to $77,727, and then we recognize that that $77,727 is actually more than the value of the $75,000. So that means the building value has to go down by $27,227. Now, in the previous year, let's go back to that slide. The previous year we recorded a revaluation surplus of $2,000. So this is just giving some of that back. So the $727 gets taken out of that revaluation surplus. So I'm lying to you. The $2,000 gets taken out of the revaluation surplus because it's all gone now, right? And so that revaluation surplus goes down to 0, and then the extra $727 becomes a revaluation loss. And because it's a loss, it doesn't go to the equity account, it goes directly to income this period. So that takes care of that example. All right, the fair value model. So we've talked about the cost model and the revaluation model. Now the fair value model. For investment properties, this is one of the choices. So an investment property is the only tangible capital asset that may be accounted for under the fair value model. Changes in its value are reported in net income in the period of the change, and no depreciation is recognized over the life of the asset. Once this method is chosen over the cost method, the property will continue to be valued at the fair value until disposal. So essentially you're marking this one to market because it's an investment property. Now, disposal may be deemed disposal if it becomes owner occupied, or if it's developed for sale in the ordinary course of the business. That change in use would be a reason to give you the opportunity to change your accounting method. But once you've chosen this method over the cost method, as long as it's just used as just an investment property, as I said, until disposal, or until the owner occupies the site, or it's developed for sale in the ordinary course of its business, you would continue to use the fair value model. Biological assets are measured at fair value less cost to sell rather than fair value, so that's not an example of the fair value model. You're probably wondering that. All right. So here's an example. Arakan Corporation purchased a shopping mall on February the 2nd, 2011. And so the purchase price was $1 million. Cost us $40,000 to transfer it, plus $3,000 of legal fees. We had to paint some stores, and we arranged mortgage financing, and we acquired some damaged deposits. And the fair values are listed as $1,040,000, February the 2nd, 2017, which is 6 years later, and December 31st, 2017, $1,028,000, and December 31st, 2019, $1,001,000. So fairly choppy changes in fair value. But let's prepare the journal entries to record these things. At the time of the acquisition, we record the $1,043,000. So the $1,043,000 is the $1 million plus the 40 plus the 3. Property transfer fee, legal fees, but not the cost of painting the store. The cost of painting the store, $2,000 would just be a maintenance expense. So it's not going to last very long. So $2,000 goes to maintenance expense. We paid for it. We paid $730, and we paid cash of $278. So the mortgage we set up was $730,000. We paid cash of our own at $278, and then it says that we have tenant deposits. So we take over the liability from the existing owners of the property, and so now we owe the $37, and they don't owe it anymore. So that's why it's part of the cost of the acquisition. Then, moving along, December 31st, 2017, we go back to the information. The value went to $1,040,000. We recorded it here as $1,043,000. So we have a $3,000 loss. We recorded it as a $3,000 loss in value. Then on December 31st, 2018, value went down a little more, $1,028,000. So that's another $12,000 loss. $12,000 loss. And then, December 31st, 2019, things pick up. It's worth $1.1 million now. Life is wonderful. We record a gain in value at that time. This value goes up from $1,028,000, its last value, up to $1.1 million. Gives us this entry. We increase the value of the investment property and record the gain for $72,000. What about costs subsequent to acquisition? So costs related to plant assets which are incurred before the asset is placed in use are either added to the asset account, capitalized, or charged against operations, expensed when incurred. In general, costs incurred to achieve greater future benefits from the asset should be capitalized, whereas expenditures that simply maintain a given level of service should be expensed. So if the cost of your expenditure, this is the capitalized versus expense issue. And so if you're actually increasing the benefits that you're going to get from your property, plant, and equipment, you would capitalize those costs. One of the initial assumptions you're making about the asset would be things like its life, and you would make assumptions about the costs required to maintain that life. So you would need to do ordinary maintenance, for example, and so that ordinary maintenance would be just maintaining your expectations for the usefulness of the asset. So that would be expenditures as an expense, revenue expenditure as it says here. If you actually increase the value by spending money on the asset, so you actually make modifications that make it more productive, or will make it last longer, or some other way you increase the future benefits that you would get, then those costs would be capitalized because it's increasing the utility of the asset. So you have two choices: you can capitalize or expense. In general, costs incurred to achieve greater future benefits would be capitalized. Expenditures that simply keep the expected level of service would be expensed. For costs to be capitalized, there has to be an increase in the future benefits, which would be such things as, excuse me, as I mentioned, the useful life of the asset would be increased, or the quantity of service produced from the asset must be increased. The quality of the units produced must be enhanced, so you've got a capacity increase. Or it could be that the new innovation, the new renovation would reduce the operating costs, and so that reduction in costs or reduction in expenditures would also be a change in the future economic benefits, and it also could be justification for a capitalization of the assets. In many instances here, a considerable amount of judgment is required in deciding whether to capitalize or expense an item. So as long as you're consistent, a consistent application of that capital expense policy is normally more important than attempting to provide specific guidelines for each individual transaction. In general, expenditures related to planned assets being used in a productive capacity may be classified as either additions to the assets, replacements, major overhauls and inspections, or reinstallation and rearrangement costs, or repairs. So those are the four sort of major subsequent costs that we would need to consider. So additions related to the creation of new assets, they should be capitalized, but now we need to deal with the other items. So replacements, okay, we're not moving here. There we go. Replacements, major overhauls, and inspections. Replacements, major overhauls, and inspections are costs subsequent to acquisition, and so they're different from just additions to the asset. Replacements, for example, are substitutions of one asset for another. Improvements substitute a better asset for the one currently used, whereas a replacement substitutes a similar asset. So replacements, overhauls, inspections. Major overhauls and inspections are similar to replacements in that they recur and are often needed to permit continued use of an asset. So would the cost be capitalized or expensed is the issue that we're dealing with here. The major problem in accounting for improvements and replacements is differentiating these expenditures from normal repairs. If an improvement or replacement increases the future service potential of the asset, it should be capitalized. Capitalization may be accomplished by capitalizing the improvement cost and eliminating the carrying value of the old asset, so the original cost. Accumulated depreciation of the old asset goes away, and you would record a loss, if any, on the removal of the old asset. And this process is essentially the same regardless of whether the cost revaluation or fair value model is used. However, when the fair value method is applied to investment property, the property's fair value may already reflect the reduced value of the part to be replaced. IFRS requires each significant component of an asset to be identified and its depreciable asset base, a depreciable base, determined and depreciated using its component depreciation. So land not depreciated, buildings depreciated, equipment depreciated under a separate depreciation schedule. If the company doesn't keep its accounting records based on these components, it must generate estimates to back up these numbers. Reinstallation and rearrangement costs could be handled as a replacement. However, if the original installation cost and accumulated depreciation to date on that asset cannot be determined, then the cost would be expensed in the current period. So if you don't actually have them separated out in a way that you can assess them and reverse those costs particularly, you would just expense the cost of reinstallation and rearrangement. If the amounts are material, then ASPE may allow you to capitalize the costs on the basis that the original assets have been significantly depreciated. Ordinary repairs. Ordinary repairs are expenditures made to maintain planned assets in operating condition, and they're charged to an expense account in the period in which they are incurred. Now, major repairs, such as an overhaul that benefit several periods, should be handled as an improvement or replacement. So if you're maintaining the engine in the truck, that's a repair expense. If you actually put a new engine in the truck that extends its life, that would be an improvement, and you would capitalize that one. Okay, to summarize, as we mentioned before, you could look at illustration 10-15 to compare the IFRS and ASPE treatment for property, plant, and equipment. Looking ahead to what's happening in the transaction or in the standard development, there's two significant projects underway for the Accounting Standards Board at the time of the writing of the textbook. They're looking at new comprehensive accounting standards for extractive industries, so mining, oil and gas, the depletion that we talked about. They're also looking at new standards for government grants and assistance, which we also talked about earlier. They paused the project. When I see that word, I think of my son, my youngest son, when he was 4 years old, was just learning the concept of playing board games and joining in us with playing board games. But he was an old hand at video games, so when he had to run away to the washroom while we were playing, I think it was a game of Pictionary, he said, "Pause the game, I have to go to the bathroom." And so every time I see the term paused, I think of Mark and his pausing the board game so that he could go to the bathroom. Anyway, the project to update IAS 20 is paused at the time of the writing of the textbook. However, it eventually intends to update that standard IAS 20 to improve the information provided to users of financial statements by eliminating inconsistencies with the framework, which will be a challenge because remember we talked about the fact that there's a few different methods that you could use to account for government grants, but none of them really fit the economic substance. So that'll be a bit of a challenge coming up with elimination of the inconsistencies with the conceptual framework. So the framework they're talking about there is the conceptual framework. IAS 16 was updated in June 2014 to deal with biological assets relating to an account for agriculture or bearer plants, so there's fruit-bearing trees and that sort of thing. The new requirements effective on or after January 1st, 2016, so a couple of years ago now. The new requirements state that bearer plants are to be accounted for similar to self-constructed property, plant and equipment items that are not yet in the location and condition needed to operate in the way intended by management. So when you're growing your new fruit trees, it's part of constructing the productive asset, and so the costs of financing and all of those sorts of things, the things you have to do to get it ready to be used to bear fruit, would be capitalized and added to the cost of the fruit tree, presumably. And that's all that I have for Chapter 10. We're done.